Welcome back to Morning Trade Live. I'm Renita Young in for Oliver Renick, and right now we're going to start out with Inside Out. Tom White will take us through a trade, but right now I want to introduce you to Frances Netwon Stacy, who is from Optimal Capital. Frances, tell us your thoughts right now on markets. They're starting off mixed for the week. We know we have earnings coming on. So what are you seeing right now?
Well, global macro at the end of the day drives earnings. And the thing is that we have so much deceleration going on in both growth and inflation that typically leads to a profits recession. You've got year-over-year growth trending towards zero. You've got quarter-over-quarter growth that, is at risk for going negative. And the Fed is still tightening. We've got a 25 basis point rate hike priced in, even though they put a lot of liquidity back on their balance sheet during the SVB period and the lending facility for the bank. So we're really headed for recession. There's so much deceleration going on in personal incomes and capex and consumer spending and savings rates and retail sales, and some of these things are starting to really fall, and so that's going to eventually affect earnings. Whether it affects earnings this quarter, how badly it affects earnings this quarter remains to be seen. But we are in a deceleration economically.
Frances, you are more bullish on gold, silver, and duration right now, correct? Tell us why at this moment you are.
Well, these things have had tremendous runs recently, so I would expect a short-term pullback. But generally speaking, yes, these things tend to do well when credit risk goes up in the system. And as you have the Fed continuing to tighten, every single day that goes by, you have the lagging effects of the rate increases that have already occurred coming into play. You have 61% of America living paycheck to paycheck, and they're buying their inflated groceries on credit cards, and that debt service is becoming more onerous with every rate hike. You've got credit card and auto delinquencies going up. And so at some point, you can sort of see the writing on the wall that some of that consumer is going to fall off. I don't think we're out of the woods yet with the credit situation, because you have a record amount of debt in the system and you have liquidity, popping for the banking crisis, but then again being driven lower, in addition to the debt conversation with Congress, coming up, very soon. So these things are all adding risk to the system, and the Fed is remaining resolutely hawkish. And so I just think that they're probably going to wait for the next boat to show a hole and then try to plug that hole as quickly as possible, as they did with the banks.
That's a good way to characterize it, just adding more risk to the system. But are there any sectors that you favor?
I mean, real rates going down, gold historically does well. When you really start to get into having a lot of credit risk in the system, which you see spreads kind of crawling up back in the background, the correlation between the US dollar and gold should change to where the US dollar and gold become correlated to one another and go up simultaneously as dual flights to safety. That's historically what occurs when credit breaks down. So an early indicator that credit is, coming to some sort of its next situation would be, kind of having gold and the dollar go up together. And we're starting to kind of see that. You have a double bottom bounce going on with the dollar from February 2nd. You've got some double top resistance from the SPX from February 2nd. And so just watching the technicals to see, if these levels are taken out or we continue as is, muted VIX, and, a lot of consensus is still on the long side of the trade, or whether or not we have a meaningful reversal. So this is not necessarily going to happen tomorrow, but, all of the risk that's building in the credit markets doesn't matter until it does, and then it matters very quickly, and you typically get large gaps on markets. So it's better to be positioned well in advance for that.
Mm-hmm. So thinking about earnings season right now, we're just jumping back in full swing. Are you expecting to see an earnings decline this season?
I mean, I'm expecting companies to decelerate pretty uniformly unless they have some kind of idiosyncratic situation. For instance, JP Morgan, that's idiosyncratic because they had an increase in their depositor base based on the fact that the bigger banks are more secure than the regional banks, given what's just occurred. So aside from idiosyncratic stuff, yes, I expect more demand destruction in the system, which is the plan for the Fed. I expect labor markets to continue to kind of start to show issues on a very lagging basis. And so I expect these things to decelerate, yes.
JB Hunt will be reporting soon. What are you looking for in that earnings report?
Well, the thing about JB Hunt is it's part of the transports. And so they're actually, it's predicted that their earnings are going to decline, but we will see. I think from the technical analysis standpoint, 175 is kind of a make it or break it. It went up this January because it reaccelerated with sort of the rest of the economy, which I would refer to as a bear market rally. But then now transports are hurting because, recession fears are coming in, and transports just historically don't do that well during recession. So I expect it to continue to, go along with that sector, unless again there's some sort of idiosyncratic thing, but it's not predicted by the street.
All right, Frances Netwon Stacy, thank you so much for your insights from Optimal Capital. Now let's trade it with Tom White, the co-host of Fast Market. Hey, Tom.
Hi.
Good morning to you.
Good morning to you.
Snowy morning in Chicago,
Yes.
Sunny morning, so snowy, sunny. But how would you trade JB Hunt right now going into the report?
Well, taking a look at the transports, this is a key, I think, sector that a lot of people don't realize. It kind of sets the tone for how the economy is doing overall. You look at the rails, you look at some of the transportation and logistics companies. JB Hunt's right in the mix there. Now, last earnings report, the stock did jump about 5% after that report. It's actually come back down to that pre-level, pre-earnings that we saw last quarter. So it's definitely underperformed the overall market so far in 2023. Option markets pricing at about a plus or minus 4% move either way in the shares, just over $7 either way. And to Frances Netwon Stacy's point here, if you start looking at levels around that 175, if it can hold this level, if we do get that pop going into earnings. So I looked at a strategy that, basically don't try to be a hero type of strategy where you can still take a directional bias, but you want to stay risk-defined in this going into the report after the close tonight. So I looked at just selling a put vertical to the downside here that's out of the money. So looking at going out to the May monthly cycle, so 32 days till expiration, selling the 170 puts, and then against that, buying the 165 strike put. Basically, you're collecting about $1.50 credit on that. That's what you can make on this trade. You got risk of about $3.50, but you've got a nice cushion to the downside to that break even of $168.50. It's about $8 below the current share price. So you're giving yourself that cushion to the downside while still taking advantage of the higher implied volatilities, which expands option premium. You get to collect more on this short vertical. But it takes that neutral to bullish type of stance going into this report if you assume that it's either going to stay here or move higher post-earnings.
All right, we're also looking at Netflix. We know they report tomorrow. We know on the fundamentals side, people are looking at the new ad tier, and they're looking at other subscriptions and the crackdown on passwords, right?
Yeah, they've been slow to roll that out, but it's coming.
It's coming, right? So how would you trade this going into the report?
Well, I think you have to look at the rally that it's had over the last 11 months. It's up 108% from those levels that we saw just last May. So take that into consideration. But the last couple of reports, as far as quarterly earnings goes, they've beaten expectations and they've raised guidance. So I looked at another strategy in here that stays risk-defined because we've got earnings after the close tomorrow, and we know anything can happen. The option market's pricing at about a plus or minus 8% move in the shares, over $27 either way. So keep that in mind. Implied volatility is elevated. So I looked at a call condor. That's a bullish trade, but you're limiting the input cost or your risk on this trade by doing this four-legged spread. So I'll break it down for you here. Going out to the April monthly cycle that expires in just 4 days, buying the 335 strike call one time, selling one of the 345 call and selling one of the 355 call, and then wrap it all up by buying the 357.5 strike call. So you're creating this four-legged call condor to the upside. You're paying roughly about a $3.80 debit on it. There's your risk. And your break even about $338.80 over the next 4 days. So this is a directional trade, but you're limiting your exposure. Now, this limits what you can make on this type of position also because you're doing it risk-defined, but it gives you that nice wide swath. If the stock does move that one standard deviation move to the upside, you get to take advantage of that. The apex of profitability on this one is between the two short strikes, the 345 and the 355, but anything above that break even of 338.80 over the next 4 days is going to be profitability in this type of position.
All right, Tom White, thank you so much for running us through those two trades.